Yesterday was a warning. Today is a collision. Welcome to Market Lens. I'm Daniel Reed. It is Wednesday, May 13, 2026. This morning, the Producer Price Index, the hidden engine of inflation, didn't just beat expectations, it shattered them. A 1.4% month-over-month surge. That isn't a statistical sticky point, that is a physical wall. While the mainstream media debates whether the Fed will cut in June, they are missing the seismic shift under the surface. This 1.4% print is the first official invoice for the AI revolution. We call it the Inference Tax. The nuclear AI backbone we discussed on Monday has hit the reality of the power grid. Energy PPI is up 7.8%. The cost of intelligence is no longer weightless. Today we decode why the zero-margin software era is dead, why Jerome Powell is digging a lava moat around the Fed in his final 48 hours, and how the Beijing summit just became an ultimatum for global liquidity. Let's look at the logic and talk about the 1.4% shock. To understand this, you have to look at the energy sub-index, up 7.8% in a single month. For the last decade, big tech grew on the back of software efficiency. You wrote code once and scaled it to 1 billion people for zero marginal cost. Those days are gone. AI, specifically the Pentagon 7 models, is physical intelligence. It requires baseload power, liquid cooling, and massive industrial transformers. When you see producer energy costs jump 7.8%, you aren't looking at gasoline for your car. You're looking at the gasoline for the data centers. This is the de-Siliconization of the tech rally. We are transitioning from a light industry to a heavy industry. Companies that didn't lock in their nuclear or baseload energy contracts 24 months ago, like we told you in the Kinetic Trap report, are now facing a margin collapse that no algorithm can fix. The PPI is the first hard signal that the AI expansion is now inflationary at the source. Trade services margins jumped 2.7%. Why does this matter? Because it means the middlemen, the producers, are no longer absorbing the costs. They are handing the bill to the consumers. But here is the hidden perspective the media won't tell you. The Pentagon 7 are the primary consumers of these services. They are currently in a market share war where they cannot raise prices on their AI subscriptions without killing adoption. This creates a margin trap. Costs are soaring at the producer level, PPI, but the deflationary promise of AI is keeping consumer prices, CPI, relatively capped. The delta between that 1.4% PPI and the 3.8% CPI is the profit black hole. We are watching the biggest margin compression in tech history, disguised as an inflation report. Watch the Q2 guidance from NVIDIA and Microsoft. The cost of revenue is about to become the only metric that matters. Jerome Powell's term ends this Friday, May 15th. In any transition, you want a clean handover. Instead, Powell is handing over a thermal grenade. By allowing these hot prints to drop on his final week without a hawkish emergency pivot, he is leaving his successor with no runway. This is what we call sovereign sabotage. If the new chair cuts rates in June, they will be accused of politicizing the Fed in the face of 1.4% PPI. If they hike, they crash the all-time high market. The lava moat is now complete. The Fed is boxed in. The market is currently pricing in a hawkish handover, which is why the 2-year yield is screaming toward 4%. The soft landing wasn't a destination. It was a mirage that evaporated the moment the PPI data hit the tape this morning. As we speak, Trump is in Beijing. The summit concludes in 48 hours. The 1.4% PPI gives the U.S. delegation massive tariff leverage. They can now argue that global supply chain contagion, read China's energy dominance, is forcing the U.S. to protect its domestic grid. This isn't a sovereign debt truce anymore. It's a liquidity ultimatum. The U.S. is weaponizing the strong dollar and hot inflation to demand a Beijing reset on trade terms. If China doesn't agree to the 14-point MOU regarding the Strait of Hormuz and energy pricing, the U.S. has the inflationary permission to keep rates high, crushing the yuan and forcing a yen-style collapse in Chinese liquidity. The Sunday gap was just the opening act. The real liquidity reset happens this weekend, after Powell leaves and the Beijing doors close. The physical wall is here. You cannot trade the next 48 hours with software logic. The Wednesday intelligence checklist. 1. Watch the 2-year yield. If it stays above 4.0%, the hawkish handover is the new consensus. 2. Watch energy-heavy tech. The decoupling of AI vision from AI economics starts today. 3. Watch the USD CNY. If the yuan breaks 7.30 during the summit, the Beijing reset has failed, and we are moving to a liquidity conflict. Stay clinical. The inference tax is real, and the bill is due. I'm Daniel Reed. This has been the Wednesday Market Intelligence Report for Market Lens. Tomorrow, we go live for the final Powell presser, the exit interview that will define the next decade of the dollar. Subscribe to stay ahead of the thermal delta. Keep your data sharp and your logic sharper. I'll see you later.